Okay, good morning. How are you all feeling? You've all had your coffee and already enjoyed some interesting content this morning? Yes? Great. So, great to see a full room. I would like to welcome you all on behalf of the Impact Hub network and share with you a little bit of why we put this event and these amazing experts and panelists together today. So yeah, I'm Santu, and I'm one of the co-founders of Impact Hub Geneva. And at Impact Hub Geneva, we are part of a global network we represent and we support over 25,000 entrepreneurs and innovators across the world. We have our locations in over 100 cities, out of which half are in the so-called global south or developing and emerging markets, however we wish to use that terminology. And we do this work, and I will share with you. We do this work because we believe that the innovators and the entrepreneurs are some of the key drivers of innovation, and they come up with let's say, sorry the word for that, but unconventional solutions to some of our challenges that we are facing today. And they're the ones also the big risk takers. And many of them are the ones that are also going to pay the price of where we're going today, because it is really in the countries, in the developing countries, where we're going to face some of the biggest repercussions of what we're seeing. And so because of that, as we are here in Geneva, we founded a program called Accelerate 2030, where our mission has been to really connect some of these amazing impact enterprises that we have in our network with the investors, UN organizations, UN agencies, corporates, and others that can unlock their networks, financing, and other for really help them on this journey. However, actually I will do share that, sorry. We actually here during this week, we are joined by some of the entrepreneurs. And normally we have them up on the stage, but actually I will share with you why we're doing a little bit of a different type of event this week. So please find them. They will actually be pitching at the event at the Village around 12:45 today. And also this evening we're hosting an after work at the Impact Hub later. Now, why are the entrepreneurs now not up on the stage, and why are we having this panel here? It's because we cannot be here without addressing some of the underlying challenges that we're facing. And part of that is actually the fact of, that's actually why we've been part of the of the building bridges from the beginning. And it's the whole access to financing, okay? It is only part of the puzzle for entrepreneurs, we know that, but it is one of the key aspects where we do need to make a shift. And here's just some of the stats. We're currently having a 50 billion financing gap for specifically impact entrepreneurs in low and middle income countries. And we know that over 2 million are actively looking for funding in this space. And this despite being these drivers for growth and impact. Now, our journey here at Building Bridges has been a little bit bumpy. We've been part of it from the start, but we have often heard, there is this whole mismatch between the impact enterprises and the actors that are here at Building Bridges. We hear that, there's just too much risk to actually even look at investing or channeling funding to this group of entrepreneurs. Too little return, too small ticket sizes, too high transaction cost, too little investable pipeline, et cetera, et cetera. And many of the players that are here today also, they're focusing on their investments on some of the traditional listed companies. And that's why we have set out to explore some of the innovation in the financial sector. And that's why also we're really excited that we are joined here by today with some of the key actors and many actually like in the mainstream space that are looking at innovative financing and how we could finance impact. And however, and this is to the panel. So while I do find like the whole concept and what we will explore here today is around impact-linked financing, yet the word I often hear is still that it's niche. And I also hear very much the same type of thinking, like the transaction costs are, too high. We need higher ticket sizes. We still have, lack of pipeline. I hear the same story even within this innovation financing part. But on the other hand, I don't know if some of you others have reacted as well here at Building Bridges this year. There has been, I feel like there's starting to be a shift, which I find quite interesting, is that we hear more and more organizations and key players talking about the whole concept that we need to count in the negative externalities and also giving rewards for positive externalities. Or we can even, like, we can put what, for example, is like carbon tax or tax on negative, or maybe another word is subsidies or reward system for positive externalities. And I think we had a panel yesterday with Pavan Subdeg, and he gave that example that if we would really account for this in our accounting system, we would have a whole different ballgame where some of the impact enterprises would be on par or would actually be highly investable because we'll be accounting for the value that they're bringing in. And so that's why I want to ask the panel today. I think that now is the time that we can see that we can account for positive externalities. Impact-linked financing no longer needs to be a niche. And to really see, what are the opportunities to bring so-called positive incentives for impact, putting a price on impact that should already from the beginning be a part of our system. How can we do this at scale? And how can we also develop financial products where the mainstream players are saying, we're part of this, we're joining, this is a clear-cut investment that we want to have. So with that said, welcome you all, and really happy to be part of this, and specifically super happy that we have Karen Wilson here, who's one of the key experts in impact financing. If you don't know her yet, please check out her LinkedIn. I can't even go through her bio. But she came from Paris last night and is joining us here today. So please welcome the whole panelist of experts. Thank you.
Great. Thank you so much, Santu and Impact Hub Geneva, for convening this really important discussion. I chair the Impact-Linked Finance Fund that was created a few years ago by Roots of Impact and iGravity. Roots of Impact has been the pioneer in impact-linked finance with a lot of support from SDC, so it's great to have SDC here on the panel. We heard earlier today in the opening plenary that there's a need for more financing in emerging and developing countries. And the good news is we have a lot of tools now today that can be used by investors and entrepreneurs to help drive more capital into those markets. So I'm really delighted to have this excellent panel here with me today. And I'm going to introduce them in a moment. But you might have noticed that aside from me, I do have an all-male panel, which is usually not allowed. But at the OECD yesterday, I was actually moderating an all-female panel, and I did wonder if that was not appropriate. So I think the blend of yesterday and today, I think it's all good, right? So I hope it's okay, but I just wanted to mention. So on my right, we have Matthew Sancerre. He's the CEO of Timeo Impact Fund Solutions. Then we have Michael Rieser. He's Associate Director at UBS Optimus Fund. Then we have Peter Bez. He's Senior Program Manager and Advisor at the Swiss Agency for Development Cooperation. And as I said, he's really been a key actor in the field of impact-linked finance. Then we have Brian Milner. He's founder and CEO of Excelli Africa. So what we wanted to do, we have less than an hour, and we want to make sure to have time also to hear from you all. So we're going to have an interactive conversation here, and then I'll open up in the last 10 minutes for a Q&A. So please already be thinking of your questions, and I'll collect them. But Matthew, I wanted to start with you. We know that impact entrepreneurs in emerging markets face a lot of challenges in accessing finance. Can you provide an overview of the impact financing landscape for us to help set the scene? Thank you.
Sure. Good morning, everybody. I've got a few slides prepared, and I'm going to go very quickly just to give you guys an idea of the scene we're talking about today. And we're going to talk about very interesting structures, so I'm excited to present them to you with my panelists and also answer questions. So I promise I'm not going to use the word niche, although with that first slide I was already tempted. So the market we're talking about today is the private assets impact market, which is the little red circle there. So those are the statistics that we've got from 2022. And as you can see, it's a small market. And if you put it in perspective with other markets that we think about, impact investing, sustainable finance, or the global assets under management, that's a growing but still a small market. So I'm very happy to be here today so that we can actually talk about very pragmatic ways to help capital allocation towards impact investing. I hope we're going to demystify also everything which is linked with the structures, the risks, the size, and I'll give you guys a few examples of funds, and hopefully that'll be broadening your perspective on the topic. So just maybe a couple of pointers on this table. We are tracking, and we have been tracking at Tameo, the impact industry, and specifically funds in private assets for the past 15 years. And we do see not only the market is growing, but the number of funds is increasing. You can see the statistic there from 2022 to 2023. And it's quite interesting to see where the capital is actually going to. So this is the number of funds, and it's actually a very good proxy for the AUM as well. What we see is a lot of development towards climate and energy, a little development in terms of microfinance, which I think when we think in terms of impact investing is really the first theme, the first foray into the theme. And what we do see is, you know, in terms of focus, when we talk about impact investing and we focus on private assets for developed countries, a strong focus on sub-Saharan Africa, obviously Latin America, a lot happening in Southeast Asia as well. But I think the key takeaway here is it's a market which is really increasing in terms of diversity, in terms of jurisdictions, in terms of themes as well. Climate, healthcare, education, agriculture now are very, very important themes. Of course, microfinance is a big theme. I think when it comes to impact investing, there's a sense that private debt is the bigger market, but it's not. It's actually private equity. And within private equity, the big bulk today is really around climate and energy. So my message with those three slides is, you know, that's a very diverse market that I think can cater for a broad range of interests, a broad range of players, and a broad range of jurisdictions and economies. Today we're going to focus on emerging market, but of course developed markets are becoming strong focus as well when it comes to impact investing.
Great, thank you so much, Matthew. As you said, the market is growing, which is great. But I also think we're seeing increasingly a mainstreaming of some of these concepts and ideas that go beyond the, quote, impact investing market niche. And I think that's really promising. And again, there are a lot of tools that are helping to do that we'll be talking about in a second. But maybe I'll just come back to you quickly. You talked about some of the examples and lessons learned. Can you share a few of those just to make it a little bit more real?
Sure. So maybe back to Santu's point as well. I think there's a sense that there's not many avenues to allocate capital towards structures in impact investing markets. Today we're going to talk about impact-linked finance, and I think that's a very innovative way to do so. But there's a number of avenues for different sizes of capital as well. So maybe it's worth spending 1 or 2 minutes to talk about blended finance. So blended finance is obviously partnerships between public and private capital. But I think what people don't really know when it comes to blended finance is the large range of opportunities there are for investors. So I've got a few examples that come to mind. There's a Mirova solar fund, which was one of the very successful funds when it comes to solar energy, which introduced or used the tiered systems of tranches. So junior, mezzanine, senior tranches catering for specific risk return and different appetites. And there's a number of other funds. There was a fund managed by Bamboo Capital Partners with the UN Capital for Development agency, which also introduced the tranches, but because it was a fund aiming for the last mile financing in least developed economies, there was also guarantees on principles. There were also financing for technical assistance. So all those are tools to mitigate risk associated with those products. And another example, which is not probably the first one that comes to mind when it comes to blended finance, is not just the concessional capital part where you aim to reduce the cost, the cost to accessing the capital, but also securitization vehicles. Just to name a few, there's an MSME platform from Symbiotics that traded more than 2 billion of notes in Luxembourg SPV, which is a vehicle that I think every investor outside of impact investing is very familiar with. There were IX bonds issued and listed on Singapore Exchange. I think not many people know that. Again, mitigating risk and providing liquidity for investors. And there's even examples, notably with responsibility, of structuring through CLOs, collateralized loan obligations. Now, those are a bit controversial since the financial crisis, but that's another example of a very successful product that allocated a lot of capital for global emerging investments.
Great, thank you so much. So you can see there's really been a lot of innovation in this space. There are a lot of tools that can be used. And the very interesting thing is that impact-linked finance actually brings together concepts from impact investing, blended finance, and results-based financing together, and it's really at the intersection of that. So, Peter, I'm going to turn to you to explain a little bit more about impact-linked finance. Thank you.
Yeah, hello everybody. So I think most of the things have already been said, but not by me. So I'm going to define a little bit impact-linked finance. What we understand here is the little red intersection here in these three circles. You heard a lot from Matthew about blended finance already, impact investing as well. And the third intersection is with result-based finance. Impact-linked finance means we are paying for agreed targets, and when they are achieved and verified, then the payment happens, okay? So it is directly linking financial reward to the achievement of positive outcomes, and the three characteristics we have here is that it's market-based. So we want to work with enterprises, the private sector, incentivize them to create positive impact or avoid negative ones, but it's mainly about positive impact. And if we talk about enterprises market-based, this does not exclude hybrid companies. So if somebody sets up a structure with a for-profit and a non-profit thing, this can still be used for impact-linked finance, of course. What is important is that private sector money, impact investment flows in it as well. Outcomes-based has been already explained. So we reward additional positive outcomes, additional, very, very important. We are not paying for something that is happening anyway. And catalytic, yes, of course, we want to enable increased positive impact and private investment into these high impact enterprises. That's the idea behind it. We are very small. The public donors. Even if you count the philanthropic donors, it's not enough. We need to mobilize the private sector investment into achievement of the development goals, SDGs. That's a little bit the theory behind. The more social or environmental value a company creates, the lower the cost of capital or the payment for impact, the higher the profitability. And if we want to change the whole system, then the money flows to the best companies in the world, but in terms of achieving impact, right? And that would be then, of course, really cool, so they can further optimize their impact. And then the resources would be correctly allocated to what the society really wants, and not only what pays off in terms of financial profit for an individual firm or an individual, right? So that is very important here. It's our dimension of system change. Two quick examples. Impact-linked finance can be used with every financial instrument, debt, equity, revenue sharing, mezzanine, whatever you can imagine, you can plug into this an impact-linked finance component. We started with the social impact incentives, very simple, inspired by the social impact bonds. We thought, can't we do this simpler? And we said, okay, let's do a contract between the outcome payer and the impact enterprise, agree on a few KPIs, metrics they should achieve, and then pay for them, of course, after verification. And usually under the condition that they receive impact. So the risk of impact production is with the impact enterprise and the investor. They pre-finance the production of impact. Once it's achieved and verified, we pay for it. Very simple in theory. In practice, there are, of course, some complications, but it works. You can do this, for instance, as well with an impact-linked loan, where you say, okay, if you achieve these KPIs, then you have to pay less interest. Less interest can even mean minus, right? That you don't have to pay back the full loan. This has already experimented with and works as well. So that's my quick introduction.
Thank you. You hold that. I'm actually going to, go to Michael next, but I'm going to come back to you because I want to hear more about some of the opportunities and limitations in impact-linked finance and how we can scale it. But Michael, because you mentioned social impact bonds, I wanted to come to you. UBS Optimus has been very active in outcome-based financing and involved in some of these SIBs and DIBs. We love acronyms in this space, so those are social impact bonds and development impact bonds, but actually they're not bonds. They're outcome contracts, so they shouldn't be called bonds. But anyway, can you share some of the experiences that you all have had in working with outcome-based instruments? Thanks.
Yeah, sure, happy. And thank you for the question, Karen, and thank you to Impact Hub for hosting this discussion. It's a pleasure being here. If you don't mind, maybe before I start answering your question, I would just explain briefly our Optimus Foundation's approach to social finance, which also neatly explains like how we operationalize our work focusing on impact-linked finance. And so we see social finance as a way to achieving social or environmental outcomes, which sits on the spectrum of capital somewhere between, and on the other hand side, sustainable financing, which the bank UBS is doing. And more concretely, our social finance work has 3 pillars. One is that we need to build the ecosystem in order to be able to make the investments we're also doing. And we do this by funding research pieces, funding incubators, accelerators, or also providing design funding for larger initiatives. The second pillar first is our direct investments. So we directly invest into social enterprises. Frequently, we also are using impact-linked finance, for example, impact loans, but also equity and instruments convertible to equity. And this is also the pillar where we have been, as Karen mentioned, we've also piloted these impact bonds, or which we now prefer to call, as Karen mentioned, outcome contracts, because yes, they're not bonds, but they're much more a contract between different parties for delivering outcomes. And then the third pillar is blended finance. Matthew already mentioned it. This is how we kind of try to scale our work, in many cases by involving also UBS, the bank. And we think that the kind of these 3 approaches together are quite interesting because it helps us to kind of like really support very early stage innovations, then test them as a foundation, and then also scale them with the bank. Now coming back to your question on the learnings, I think the first one is that impact-linked finance is really not rocket science. In other sectors, if you want to achieve a certain goal, very often we do link the achievement of this goal also to financing, for example, through retainers or bonuses. And if we want to achieve now impact with our investment, it's only natural that we also link our financial terms then to impact. And there's a range of different tools, as we've heard from Peter as well, but some of them are fairly straightforward to use and can be used by investors without the need for external support. And this capacity can be built in-house. Maybe it's helpful in the beginning to have some support from some intermediaries, which are also there, but it's something which investors can do themselves. The second point is that we think impact-linked finance really goes beyond just incentivization, but what we kind of think is a bit undervalued, but actually very helpful, is also that impact-linked finance really helps to operationalize impact, because it forces all the stakeholders involved to really, from at the beginning of an investment, to think through like what are the things you really want to measure, how do you measure them, how you then also you need to revisit them, because throughout the investment period you need to look at what actually has been achieved. And you need to also discuss what are the concrete targets. And I think going through this process is super helpful. And impact-linked finance pushes all the stakeholders to do that, because otherwise you can't set the financing terms, so you can't execute the investment. And yeah, we think that's very valuable.
Great. And as you said, it's really key to set the incentives appropriately and make sure they're aligned between stakeholders. Can you give some examples or some lessons learned about how best to do this? Or Peter, I could also come back to you.
Yeah, I think there are different ways, right? So for example, as a foundation, I think there, in the past, we were also doing impact-linked loans where we as an investor were giving up some of the return. And philanthropic investors can do this to a large extent, right? So in the past, we also had like loans where the interests were varying between 0 to 10%. It wasn't going negative, but still close to 0. But this can still be done as well by mainstream investors, which can just then reduce maybe the range of the interest paid. But then there are also other instruments which can be used, which I think also is a bit aligned to what you, Peter, are doing with impact-linked funds, where you have a third party which pays for the outcomes and finances wedge, for example, in the interest paid by the business and by the interest received by the investor. And then the interest is really aligned. Like the investors wants to achieve more impact because they get a higher return. The business wants to achieve impact because it pays a lower interest rate, and the outcome funder is able to pay for the results.
So you probably, in the audience, you're probably thinking this all sounds really, really complicated. Actually, impact-linked finance, and particularly the sinks and the impact-linked loans, they're simplified versions of some of the other outcome-based financing instruments. And so it makes it easier to implement, and the rewards actually go to the entrepreneur, whereas in some other models, the rewards go to the investors. So Peter, can I come back to you to talk a little bit more about impact-linked finance, maybe give 1 or 2 examples, and or talk about some of the lessons learned so far in terms of what it can do and what it can't do?
Yes, examples we have a lot. You can take whatever you want as a social enterprise and then sit down with them and agree on metrics and reward them for impact. It can be a cook stove producer, it can be a water filter producer, and you will hear from Aseli how you can do this large scale as well in agri-SME finance. So not going too much into detail with examples. The usual thing is you agree on 3 KPIs, you have a contract over 3 years where they have the time to produce the impact. You pay out up to a ceiling, a certain ceiling, if the impact is achieved, or pro rata, and that's it, more or less. And of course, the verification is important too. And that's where come the transaction costs from. You don't want to overburden the company, of course, with totally things that are against their business model, but you can transform it. But let's go to the limits and to the benefits. So limitations are, as you can imagine, you need impact measurement management. If you don't have data, how can you agree on baselines and targets? If you don't have projections and a system where you get the data out of, how are you going to verify then the achievement? So that's unfortunately necessary. As you all know, not every social or impact enterprise has this kind of data. So sometimes you need to do some steps before you arrive there. The other thing is, of course, ticket size. Yes, if you say it's conditional that they need to raise investment, they need to be a little bit out of the missing middle most of the time, because otherwise they don't find an investor. So you cannot do it. You cannot do it easily with every kind of enterprise. Again, Brian will give you more examples how to work around this, and I think with technology and other progress we will go always a little bit deeper down with impact-linked finance. So that's a limit. Then another limit is, of course, we do not have enough outcome payers, okay? STC is a small donor, there are many others following, but we need many more outcome payers. In terms of benefits, well, it works. It works. You really can incentivize people to achieve impact. You can tell them, go more rural, go to this country, work more with women, show me your impact, go deeper down in the impact, go to low-income households. So this really works, it's working, and the beauty of it is that you can even transform business models. So you may work in the beginning only with like-minded social entrepreneurs and increasingly impact enterprises, when in theory, if you have enough outcome payment money, you could change Coca-Cola and Nestle produce better projects and compensate them for the positive impact, okay? So there's a huge potential for making our economy more inclusive. Like you said, impact is operationalized, quantified. We now have a price tag. It's in the profit and loss statement, so we can do and work with it. That's really the power of impact-linked finance. And that's where I see a huge potential for system change, not only at the level of the individual enterprise, but at the economy and, of course, working via impact investors. You mentioned that we have these blended finance construction, structured funds, technical assistance facilities, risk reduction, guarantees. Our vision is that impact investment funds need as well either an own outcome payment facility or access to an outcome payment facility. Brian, again, can tell you more about this, how this can work in practice.
Terrific. Yeah, what I really love about impact-linked finance, or all the things that you said, and also embedded in that, was that the impact is actually embedded in the transaction. And so it's not something you do on the side or you do after. You don't go into it saying, oh, I want to have impact, I hope and pray I'll have impact. You actually figure out ahead of time with the entrepreneur, with the outcome payers, exactly what kind of impact you're looking for, and that's measured. And the other good news is that there's a lot of great work going on impact measurement and management. My panel yesterday at OECD was actually on that topic. There are a lot of players out there. There was a session in here earlier about that. So lots of progress, still lots of work to do, but lots of progress. Michael, I see you want to come back in.
No, if you don't mind, maybe I just would add briefly to the instruments, which Peter mentioned as well. I think they're also, and as Matti also said before, it's not niche anymore, actually. There are certain things which are currently being done by the public sector and by philanthropy, but there are also some tools actually which are being scaled already by the private sector. Maybe two examples to mention here are sustainability-linked loans, which are essentially impact-linked loans and impact-linked finance. And I think in the year 2022 alone, more than 300 billion in sustainability-linked loans have been issued. And the second example, more in the private market, would be performance fees for funds which are linked to impact. And that's also something which, to our knowledge, has been adopted by more than 80 funds already.
Terrific. So Brian, now I want to turn to you and hear your thoughts based on the Exceli model and also your experience on the ground. Please.
Thank you. In East Africa, 65% of the population depends on agriculture for their livelihood, but only about 5% of commercial bank lending is going to the sector. And the question is why? Prior to setting up Exceli, I spent 12 years working at an impact investor, Root Capital, that lends to small, medium enterprises in agriculture across Africa, Latin America. And we experienced the risks, the costs, and really a very challenging market. And in 2017, we came together with some of our peers and competitors, groups like Responsibility, Oiko Credit, Incofin, and we convened a meeting with donors to talk about the challenges we were all facing in the market and the need for some type of risk-sharing incentive mechanism to boost returns so that we could earn some minimum return and keep capital going in. And the feedback we got was twofold. Number one, this is anecdotal. Can you put data evidence behind your assertions that this is not a functioning commercial market? And number two, you're a bunch of international impact funds headquartered in Zurich and London and Boston. What about local banks, local lenders? And so we went out, we spent 2 years working with Dahlberg. We gathered data from more than 30 lenders, a mix of these international impact investors, local banks, non-bank lenders, serving small and medium enterprises, SMEs in the agriculture sector, specifically in East Africa. And we began to quantify the return gap. And we found that risk in agriculture is at least twice as high as in other sectors. And that only accounts for the loans that are being made. And we know that at least 3/4 of small and medium enterprises in the region are not accessing finance. So we're underestimating the real risk of serving this market. And the second thing that we found is that there's a significant return gap, and risk only accounts for about half of that gap. The other half is higher transaction costs. When you can consider maybe an urban-based lender, a bank, going down the street, underwriting a business, returning the same day to put together the credit memo versus driving 4, 6, 8 hours into the countryside and all the additional time and effort that goes into it. So interestingly, the World Bank, others hadn't quantified this data, and we went back to the donors and we made a pitch for an impact-linked finance mechanism. SDC was one of the pioneering funders, USAID, IKEA Foundation, and others. And so we've raised about 65 million in grant funding, pure philanthropic funding. We pool that money together, and then we offer it as incentives to a marketplace of lenders. We're working primarily with local banks and non-bank lenders in East Africa, as well as international impact investors. And for every dollar of donor-funded incentive or subsidy, lenders are putting $10 or $11 of private capital into the market. About half of that dollar that we offer is in the form of a risk sharing, and it forms a reserve for the lenders. It's available to cushion losses. We may get that money back. We may be able to give it back to our partners or recycle it. The other half of that incentive is a transaction subsidy. And we're recognizing, again, the higher operating costs of serving this market. We want to bring up the returns for serving agricultural small and medium enterprises. And the reason for that is that they're aggregating smallholder farmers, linking them to markets, they're creating jobs, they're increasing supply of healthy and nutritious food domestically, reducing reliance on imports, et cetera, et cetera. And so the idea here is, how can we build this across a marketplace? And over the last 3 years, we've worked with about 30 lenders, mobilized 1,300 loans. The average loan size is about $100,000, so much bigger than micro, much smaller than a lot of what the international impact funds would be doing. So about 140 million of capital going to businesses, and 60% of those businesses are accessing finance for the first time. So capital additionality is a big priority for us. It's part of how we structure our incentive. So we offer lenders a higher reward for serving first-time borrowers. And then we also have impact bonuses around gender and youth inclusion, food security and nutrition, and climate and environment. So we want to motivate lenders to seek out and serve the highest impact businesses. There's certainly a lot of challenges in this model, somewhat different from the SIBs and the DIBs. The outcome for us isn't at the end. It's not in the repayment of the loan. It's rather at when the loan is issued. Once it's been outstanding for at least 90 days, at that point we say the impact has been achieved because capital went to a business that meets certain impact profile.
Great, thank you. So what do you see as the potential for impact-linked finance, and how can it be further scaled? It's great to hear what you all are doing. That's fantastic. What do you think is the potential to build the market further? And Peter, if you want to come back in, or anyone else would like to come in on this too.
I think first it's for us and many of our partners is getting past the ideological impasse of how are we going to subsidize commercial banks. There's, a lot of donors understandably are reluctant to subsidize banks or any financial institution. So we look at it through a different lens, which is how do we achieve impact in the most cost-effective way? And if we start from that perspective and recognize that commercial capital isn't flowing, what's it going to take to get capital to these high-impact enterprises? And then we put a price on that, and we reward a marketplace of actors. And the emphasis has been on local lenders. So there's a philosophical reason for that. Of course, we all want to see a robust local financial marketplace, but there are also practical reasons. Local banks are capturing deposits in local currency. They have a branch network, a footprint across the countries that we're trying to serve. So their cost to serve this market is much lower. And then the how is much harder. Working with large financial institutions to try to get them to shift their strategies and be able to change their credit risk policies, get Treasury on board. There's a lot of kind of operational challenges that come up along the way. So it's critical to have partners like SDC and others that are in it for the medium to long run, 5+ years. These changes are not going to happen in 6 to 12 months.
Thank you. And Peter, I want to turn to you. SDC is actually built upon the experience that they've had so far and is in the process of working on a new platform, right, to help scale up impact-linked finance.
Yeah, there are different bottlenecks in impact-linked finance. We talked about impact measurement management, but many people are working on this. We talked about outcome payments. I will come back to this later on. And there's, of course, advocacy, so changing mindsets, getting more people into this. And another point is implementation capacity. Karen mentioned already that we have Roots of Impact, we have iGravity, we have Aqua for All, and there are already other players in this world, but we need more of them too. And we need to control the quality. We want to have high quality, because what we are promising our outcome payers is if you pay $1,000, it's more than $1,000 that is arriving at the low-income household in rural Africa, at least 1,000, and maybe even system change, things like this, okay? So that's what we are promising, and we are verifying it. So we want to keep these standards high, so more money will flow into this, even from private donors in the end, we hope. So getting the level, a good level, that's important. So the Roots of Impact, one of the most important players in the field, is ready to try to share its knowledge on platforms, so people can easily learn and benefit from this, and of course then do something in terms of knowledge sharing, collaboration, things like this. So that should build the field so that we have more implementers. And the other thing we think is very important is that we have some kind of ILF collaborative where different stakeholders of the industry work together. First of all, the outcome funders, we need more funders, but then, of course, as this will have some public good character, we need as well some money in it, so we can do joint research, joint knowledge management, think about standards, certification, capacity building, all these kind of things. It is a lot of work to convince people that this is the way to go. It sounds easy, but if then you want to convince your boss that he's putting money into it and resources, it takes a while. So we need to standardize and simplify this.
Great. And the good thing is that there's now a track record around this. There's evidence that these models are working, and soon there'll be this platform that will bring more people together around it. So lots more to ask the panelists, but I promise to open up to the audience. So I'm ready to take questions. I'm going to take them all as a group and then let the panel answer. I saw your hand first, and then here, and there was some in the back. So please keep your questions brief because we don't have a lot of time. Thank you.
Yes, elephant in the living room. How are you going to do, I love your comments, sir, on these statements on verification and quantification and data and so forth to reward companies. How are you going to quantify carbon reduction? how does that, how are you going to account for a ton of carbon in what you're doing? Eventually, that's going to have to happen.
Great, thank you. Next question.
Swiss Water startup trying to bridge the gap between SDG 3 and 6, so public health through hygiene, but avoiding damage to the environment. We developed a technology, built a machine, invested in India. Result, very different from the expectation. We had a success in the private sector, especially in the real estate and facility management, while we wanted to really hit the SDGs. So partially because of the corruption of the government, partially because of a lack of budget to explain the value of those goals. Question, how can we, so we are successful, it works, so the company sustains itself, but we would like to go to what was really the purpose, which is to explain maybe that preventive health is less costly than curative, than developing the rural areas or the slums would have benefits for the country. That means a communication campaign. How can that be financed?
Great. Thank you. Thank you for the example and for the question. Just a note to the other people with questions, please keep it short because I want to get as many questions in as possible. But that was a very helpful example. Thank you for that. Lady here in the front.
Hello, Joan Fulton from the Ocean Assets Group, helping drive finance to SMEs in the blue economy. And my question really is to Brian. I notice you're all in Africa. We're predominantly starting in South Asia, Southeast Asia, and Pacific Islands, which, when you talk agriculture, you're talking aquaculture. So your council, smallholder agricultural finance, does it include aquaculture, meaning both seaweed and fish?
Okay, thank you. And there were hands in the back. So yes.
Let's say you're a founder with a crazy idea. What advice would you give to entrepreneurs starting out in this space in terms of structuring companies to look attractive for impact investment?
Okay, and there were some other people around you. I think a lady in front of you. If you can put your hands up again.
Hi, yeah.
Okay.
Can I go?
Yes, please.
Hi, I'm from India. I'm on the founding team of a startup that works with dairy farmers to double their income and halve the carbon footprint. My question is about impact funding. What we find that impact investing and reporting tend to have high overhead costs with many layers of organization. So my question is, do you see an opportunity to disrupt this through direct-to-beneficiary models? And the second question is, any good examples for this, please? Thank you.
Okay, so, I'll take a few more questions. I saw you first, and then the lady behind you, and then you, and then I think that's all we're going to have time for.
Yeah, thank you for this panel. My question is really easy. How we need to raise capital to have more impact. That's obvious. In today there is a standard, it's the ESG standard, which I think if you know it doesn't really represent what does it mean to have an impact. And I think we have to really rethink what does a company having impact mean, and do the ESG standard represents this impact? Is it that right, or do we need maybe to invent another standard that would be more representative?
Thank you.
Oh. Rethinking that would be.
Thank you. Do we really need more standards? Thank you. Okay, the lady behind.
Hi, this question is for Brian. I was just wondering, I think one of the big issues is a lack of subsidies in smaller markets, and I just wanted to ask you, how do you work with local insurers, like agricultural insurers?
Okay, and the final question here.
Peter, this question is for you. Do you invest directly in companies, or do you go through funds?
Okay, thank you. And I know there were more questions, so hopefully the panelists can be here afterwards to talk with you individually. Brian, you had a lot of questions. Actually, I'm going to give you more time to think about answers, and I'm going to start with Matthew, and I'll just go through the panel this way. Thanks.
So there's been so many questions, I can probably talk about what I did last weekend and still answer some of them. No, maybe just to your point and some of the previous questions, I think what's happening right now is very unique in a sense that a number of companies that were used as reference players, so MSCI and the likes, I think have lost a lot of credibility. At the same time, you've got regulation that has been implemented through SFDR until June this year. And yes, it's not perfect, and there's obviously consultations now about the best way to take the regulation forward. At the same time, you've got, I think, investors, shareholders, employees in companies that are very, very keen about the idea of thinking ESG, thinking impact, thinking sustainability. And to blend that with the reporting question from the lady in the back, I think now is probably the best time to do that, because I think companies that do care about transparency, do care about some of the standards that exist, and I actually think there's too many standards, but consolidating those and providing proper reporting, which actually doesn't come at a very, very expensive cost, especially if you put that back with the perspective of large fund. And granted, in some of the project-specific reporting, then that might be more complex. But I think now is a fantastic opportunity. I think it's almost like a perfect alignment of planets where if you really do care about impact investing, if you really do care about making a difference through reporting and transparency, you've got the tools, you've got the momentum. There's some funding, maybe not enough funding, but definitely a strong sense of track record building, a strong sense of risk mitigation. I touched upon some of the mechanism and some of the tools. So I think I'm actually very, very positive right now. And of course, there's a huge task ahead. But I think everybody on this panel is very positive. Otherwise, we wouldn't be here today.
Thank you. Michael?
Yeah, maybe just comment briefly on the pricing of the outcomes. I think carbon actually is probably a good example where we actually have a decent understanding what the price would be based on the damage it does. Plus, also there is actually a market out there for outcomes for carbon, right? Because I think carbon markets can be seen as a market for outcomes. It gets a bit tricky with in other sectors, but even there it can be done, or we have seen that it can be done. For example, in some of our education outcome contracts, there the pricing there is then really a standard deviation increase in learning gains per children per year. And this can be priced then and can be compared over different programs. And going through this is extremely valuable because it helps you to compare different programs to each other and helps those outcome funders to decide where it's worth putting their money. And maybe just commenting on kind of the link to your question and also to another question, the effort we need to put in to measure all of this, I think not doing it is not an alternative, right? And impact-linked finance can actually help us to push us to it, and we shouldn't keep imperfection keep us from doing it. If maybe then we start first with something imperfect and then we improve and get to a point where we really believe that this is valuable.
And related to that, financial reporting was not perfect 100 years ago. We didn't even have it. And over the years and decades, it's been improved, and we think it's a science. It's not a science. It's still being improved. Same with impact and impact measurement. We're no longer at the starting gate. We're out of the starting gate, but we're making progress. So don't try to be perfect, but get started, get moving. Yeah, Peter.
When I talk about impact, you may have noticed that I'm all the time talking about achieving the SDGs, low-income people, low-income countries, and so forth and so back. This is the beauty of impact-linked finance. As an outcome payer, you can, together with the enterprise, define what you understand under impact, okay? And this means if it's carbon, well, we can agree on a price for carbon if it's not sold via the market. If it's health prevention, we can talk about what price we would assign to this. So this is definitely an advantage and allows a lot of flexibility. Even if somebody else understands impact differently or works in different geographies, we could still work together with UBS Optimus Foundation and earmark to a certain extent our outcome payment and still work with the same kind of implementers. We usually do not invest invest directly, but work via investors or even try to catalyze investors. That was your question. And then perhaps concerning your question, what about preventing health? How do we do these kind of deals? We identify somebody who is ready to create impact, right? And that could be preventing health damages. And then we usually see what's it worth. We are doing a cost-benefit analysis. So if we, over the next 3 years, are paying out each year 100,000 or something like this, 300,000 to create impact, plus our transaction costs, will we get the equivalent in terms of impact as we understand it? This can be easily measured, like somebody saving charcoal because he's buying a cook stove, or it can be a little bit more complicated, preventing health. Then you may find lots of studies, what's it worth for society. And then it's up to me to decide if I think these studies are relevant. So it could be that I have a study from Uganda, and I think, well, that's more or less the same thing as with our health enterprise in Kenya. Maybe it's a little bit less. Let's take some conservative estimate. And then I say, yeah, helping 10,000 people, or we have an example from Mexico, helping 10,000 more people from the bottom of the pyramid to have access to excellent diabetes prevention, that's worth 270,000 plus transaction costs for me over 3 years, right? It's something like $40 per person, cost effectiveness. And once I have this established, then the company could go to the state, if it would politically economy possible, and negotiate with the state to continue the outcome payments. So they say, hey, these Swiss guys, they pay 270,000. For them, it was at least $40 worth. And by the way, here's the story. It's something like 4,000 or 400,000 or something like this. So why don't you take over and we go together to scale? So I think that's a way forward, how you can move things. And again, you see the beauty of impact-linked finance. It's not only about this company. It can allow you to change a system. You can go to scale and convince the state to work with you at scale.
Thank you, Peter. So now, Brian, in the last couple of minutes of the session, you get to answer all the other questions.
I'll tackle a couple of them. So we define agriculture broadly to include aquaculture, fisheries, and sustainable timber. So we're working across all those sectors. I'd be happy to talk with you afterwards. But of course, we're in 4 countries and 1 sector, and the need is global across so many sectors. So we've had an interesting experience over the last year and a half working with a nonprofit in Mexico that wanted to set up its own incentive facility. Initially, we were thinking about expanding and realized that didn't make sense. We identified this local partner. They had raised their own funding, but they needed some support in designing the mechanism, getting the impact approach in place, et cetera. And so over 18 months, we've been advising them. They launched earlier this year. The platform's called COA, C-O-A, and they're offering incentives to agricultural businesses and farmers in southeastern Mexico. I was talking this morning actually with Charlie from Dahlberg, from the Nairobi office, about could you apply a similar approach in the education sector in Kenya? So I think it's really about understanding the market. If commercial capital isn't flowing, being able to quantify to the extent possible the risks, the transaction costs, and then overlaying impact, and having an ongoing open conversation with the donors. And depending on how good the evidence base is, it's going to be a shorter, easier path with the donors or a much harder one. It took us 3 years to get off the ground. There's a question around insurance. We're not there yet. So we've started working with a number of lenders, and then over time, I think there's opportunities to tighten the ecosystem with insurance companies, with policymakers, and that's the next phase of the work.
Great, thank you. Well, the time went way too fast. I wanted to come back to the panel for final closing thoughts, but I see we don't have time for that. So I just wanted to link back to what Santu said in the very beginning. We have a growing number of entrepreneurs across emerging markets and developing countries with great innovative ideas. We also have more and more investors that are looking to support those kind of innovative companies. We have more and more tools that can also be applied, and the key now is really to scaling up the use of those tools. So I think this panel was a good step in that direction for raising awareness of what's out there, and also this platform that the SDC is supporting, which will help build greater awareness about impact-linked finance. So thank you all, and a huge thanks to the panel, and I think lunch is next.